Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week, as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, November 8th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing well. Will, thank you very much.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right, we had another volatile week last week. We came in with all eyes were on the Fed meeting from Tuesday and Wednesday with waiting for the Feds to raise rates 3/4 of a point, which they did as expected. And the market kind of it sold off immediately, then it went up, and it took off again on Friday. People are kind of mixed on that. They know they kind of expected the 3/4 point hike to fight the inflation, but the higher you go, the faster you go, you still raise the risks of inflation. Now, we also had some economic data that showed that better than expected, and jobs data was still resilient, and we still have a tight jobs market, which as far as Fed watchers go, that just kind of gives the Federal Reserve a little bit more emphasis that they can go push rates up a little bit higher. And of course, we did have a couple, Fed Chair Jerome Powell in his statement after the FOMC meeting basically said that we're going to be raising rates higher than we actually thought over the summer, and we're probably going to have to keep them up longer. And that's still troubling to investors. We got up to the 10-year T-bill hit 4.21, 4.21% last week, which is actually the highest level since 2007. That it dipped back a little bit, back to around 4.16. And the 2-year right now is pushing up around 2 3/4. That's again that's the highest level since around 2007 too. So that's kind of keeping a little bit of a lid on the market. We also had mixed earnings. They did little prop up stocks. We had some blowout numbers, of course. From Uber had a good one. BP, Pfizer was strong. Amgen, Starbucks. But then more of the consumer discretionary and technology companies were a little bit light. Some of them actually would beat on the top and bottom line, but they pretty much across the board would issue a little slower guidance, which you're going to get hit hard in this type of market. So we started out the week with a couple of days to the downside. We had the Dow, the NASDAQ dropped almost 6.8% until we actually got a bounce on Friday. Ahead of the weekend. I think part of that was also looking at what was going to be happening this week with the midterm elections and all. But that's a pretty big drop for a 6.8% over a couple of days. After it bounced on Friday, we did close with the NASDAQ down about 627 points, or about 5.6%. The Dow fell less than that. However, we did get a bounce. Actually, it was down 860 points. I take that back. It was down about 2.6%. But then it turned around on Friday and ended up only down about 1.4%. So the industrials and consumer staple stocks seem to be the ones that are energy stocks where you want to be. They seem to be outperforming a little bit, much better than everything else. Now, part of the bounce was due to Fed presidents from Boston and Chicago. We had Susan Collins and Charles Evans basically saying that they thought that maybe we're going to raise rates higher, but we probably need to start to have a conversation about slowing the rate down. Maybe we go a few meetings here where we only have a quarter to a half, and that's kind of what bullish investors are taking that as the Fed's blinking, and they're going to maybe they see that they need to slow down a little bit before they push the economy over into a recession. And that also, I think, is probably one of the reasons why we're seeing some more of a carryover from last week's bounce on Friday. And we also had oil prices were a little bit higher. Part of that was on a report that China was getting ready to end its zero COVID policy, hopefully by March. Now this week, over the weekend and stuff, we kind of had conflicting stories on that. We had a nice bounce in the K-Web, which is the China Shanghai technology ETF, internet ETF. But then we've kind of gone back and forth here on Monday and Tuesday, Monday with that. As far as the sectors go, the energy sector hit a new all-time high on Friday. It just continues to outperform, and it's still strong. I think it's actually today's it's a little bit off, but it was strong again yesterday. The other positive sectors were materials and industrials. They still seem to have a little something behind them. And then on the weak side, we had technology and communication services. They were the weakest. They were each down more than 6.5% last week. We saw a lot of this was due to advertising dollars and, of course, the layoffs, that type of thing. Meta Platforms and Alphabet were just hammered. Meta Platforms is all the way back to where it was in 2015. So it's lost 7 years of gains. Mark Zuckerberg, I think I read somewhere where he lost something like $200 billion in his stock portfolio, which is kind of a rough hit. But anyway, the Dow Jones, we talked before, it finished the strongest month in October since January 1987, and but we did snap a 4-week win streak for the Dow last week. That was so it was down about 1.4%, and the S&P 500 and NASDAQ, they were down for the first time in 3 weeks. The technical condition of the market did deteriorate last week. We saw that where the averages kind of, had come up with key resistance levels, I think on Wednesday or Thursday, and kind of crossed over those levels, and then they weren't able to hold and fell down. Now, yesterday, if you read the daily letter, I talked that we saw a little bit of improvement where some of these, some of the major averages actually went back above those things. We had the 200-day moving average jump back above the 200-day moving average. S&P 500. The S&P 500 is still struggling. It needs to get back above 3,900. It is above. That's where the 100-day moving average is. So it's trading below the below the 200 and the 100. And the NASDAQ still, it's just kind of scraping along the bottom here, even with 3 days of gains, and it's still below the 50 and 100 and 200. We did see the small cap Russell 2000 take a stab above the 200. It couldn't hold it, and it fell back below that. And even the transportation is below that too. Now today we saw some of these indexes move back above a little bit, but we're also seeing we had a big bounce this morning as we came in. Again, a lot of this is hopes that we're going to have a split Congress, which we probably will, which is good for the market. Talked a little bit about that last night. We had an opening bounce today, and it's kind of coming back. The Dow's cut its morning jump in half. It was up about 480 points, actually. We're down only up about 200 right now. So having a little bit of a struggle. The other different indexes pretty much have kind of bumped into their resistance levels at key moving average levels on the upside down, and they've bounced back below those today. They weren't able to pick up the steam to hold that. Other than that, let's see here. We did see some underlying breadth. It weakened last week. Not terribly though. The NASDAQ, I think the AD line lost about close to 3,000 units, but the Dow Jones on the AD line lost about 600 units. That was nothing, not a big deal. And then we also saw that investor sentiment was kind of mixed in here. They're still a little bit overly bearish, but we are seeing small upticks in bullishness. As far as the hedge funds go, we saw the National Association of Active Investment Managers. It was pretty much even last week, so not much going on there. But one thing that we notice is currently the Dow Jones is really outperforming the other indexes. We want to kind of watch that. They have an old saying where when the generals march alone, that you need to be cautious. That's kind of what we're seeing in here. It seems to be outperforming the broader market. In fact, it's trying to make a run towards the August highs, which would be a big plus for the market. So, we have some downward sloping trend lines that the Dow's battling, and until we get above, like say 34.2 on the Dow Jones, we're still in a process in a bearish pattern where we're making lower highs and lower lows, and at some point we need to we need to see some of these different indexes start to reverse that pattern before we get more bullish.
So you said that the market historically does well after midterm elections, especially if we end up with a split Congress. The market is moving higher now for a third straight day. I know seasonally we're also entering a period of strength, and I was wondering what specific sectors look to be the strongest performers heading into the latter part of the year.
A couple of good points there. Like you said, historically, going back in the 20s, the midterm elections have, it takes away some of the uncertainty to the market. What's going to happen. And as far as the split Congress goes, you don't have one side just giving a rubber stamp and everything they want. They just keep stamping and pushing through. You're going to get more debate. You're going to have less spending, and just a little bit more of a thought process before running bills through Congress and just spending what your party wants to do. So that's why you have the market performs much better in a split Congress. Now, as far seasonally, we also are going into a strong period, and especially when you've had such a weak August, September. But we still have some headwinds. Part of the problem is we still don't know about inflation. On Thursday we had the CPI comes out, and one of these times we're going to need to see the inflation numbers actually tick down a little bit. That could if it's just like down 1 or 2 tenths, it's not going to do something. But one of these meetings we're going to have a half a point tick down or 3/4 point down. I think you'll see the market bounce much higher, especially technology stocks. I'm trying to find it for my Friday newsletter. Actually, once the rate of rate hikes begin to slow down or stop, technology is actually one of the top performing sectors. So we'll get to that. As far as the different indexes go, like I just mentioned, that the Dow Jones is outperforming, which means that the other indexes are actually kind of showing some negative divergence. Now, often in these talks, we talk about what Connie Brown, she's a technician for the institutions, and one of her things that she points out is when you see the RSI, when it's been below 40, when it actually can get back above 65 or to 70, that's a very good sign for that index or stock that the short-term trend is actually changing. Now, the Dow Jones, 14-day RSI is at 68 today, so that's a sign, according to her, that the Dow Jones is in a definite uptrend here, and we can probably see the thing, move higher. To the downside, when we have pullbacks, we don't want to see the 14-day RSI tick below 40. So keep an eye on that. As far as the S&P 500, Will, you can pull these up on the chart so that people can see these things. Let's go ahead and pull the S&P 500 up. Okay, now on this, you can see where it's, it pulled back here in November of last week, and we've had 3 days where we're a little bit higher. We did get back above the 50-day moving average, actually a little bit yesterday. We jumped up to about 38.50. As you can see on this chart, at the 100-day moving average is 38.99. So 3,900 is a big resistance level that we need to see that get above, as also represents 50% of the sell-off from the August high down to the October low. So 3,900 is kind of a line in the sand. If you also notice that 100-day moving average shows an uptick as of today on that, which means you have a rising 100-day moving average. You would like to see that go. Now, on the downside of that, it's bumped into this 3,900 4 days last week, and it could not bust above that. So that's something we want to watch. That's a little bit of negative negative divergence. And we also, on the 14-day RSI, as we talk about, we want to see that get above 65. It's only at 52 and a half right here. So we need some more strength in the S&P 500 in here. It's actually showing some negative divergence, and until we get above 3,900, that's a little bit of a red flag. Go ahead and pull up the NASDAQ. Okay, for the NASDAQ, again, I just mentioned a little bit ago, we're kind of scraping along the bottom in here from off that October low. We didn't make a new low last week. The NASDAQ low was back in the middle of October, but we're still below the 50, 100, and 200-day moving average. And in fact, even with today's bounce, we didn't even get up to we get up to the 30-day moving average, which is nothing. MACD has turned back to negative with today's pullback. In fact, we're getting ready to go negative on the NASDAQ here as we go into the last hour or so. And we also have on the 14-day RSI, we're only at 43. Again, calling out that we're going to try to hold 40 here, but we need to see that RSI get up above 65 on that. So this is also showing negative divergence to the Dow's gains. Go ahead and pull up the Russell 2000. And this has done a little bit better now. As the month started, when we saw the Dow and the Russell both got up to their 200-day moving average, the Russell ticked right on it and headed lower, went below the 150-day, and we got above we got back above the 50 and 100 here Monday and Tuesday, and actually today we had a nice pop at the beginning, but it's heading south again. We're already lower down on the day today from yesterday. And it's actually kind of sitting right now on the 100-day moving average as I speak. Below that, around 1755 would be the 50-day moving average. Hopefully, we'll hold right here around this 1785 on the Russell. That would be good. And also, again, going back to that 14-day RSI, you're at 53. So you're neutral at best on this index. Again, that's negative divergence, and you have the histogram on the MACD looking to possibly go negative. So again, we need to hold to the 78 or 1785 or so. Best if we could get up above 1800 on the Russell 2000, showing the small caps to have some leadership and try to catch up with the Dow. We'll go to the transports. On the chart, that would be the DJ20. And a little bit better on this. We had a good day on the transports yesterday. They were up. They were a healthy day. We jumped up today almost to 14,000. It had crossed above the 50% retracement from that August to October decline, but it's giving it back right now, and it's kind of flat right now as we're going into this. But on the bright side, again, we're above we're a good couple hundred points above the 100-day moving average. And the RSI on this thing is at 61. So keep an eye on this one here. If this can hold up, that would be a good sign for the broader market. That's actually kind of not quite going up with the Dow Jones, but it's close to keeping up and at least performing with it. And we are actually above right around the 50% retracement on this also. And finally, just to touch base on something, go ahead and click on the SOX, the semiconductor index. We've had a couple nice days on this, and we were up actually about 3% earlier today. Had nice jumps in NVIDIA and Qualcomm and a couple other ones, and it was up above the 50-day moving average. But we are pulling back again. This thing's starting to run out of gas a little bit. We want to see that thing stay up above 2450 or so would be healthy. It's going to have resistance up here around 2600. Of course, you'd like to see the semiconductors starting to lead a bounce. Real briefly, just to get, I don't want to go too long in here. I get a little long-winded sometime. Well, let's take a look at a couple of the sectors, because they're a have and have not type of situation here. I think as you kind of watch these things, we can tell where you want to go. Let's take a look at XLC. This is a communication services sector, and quite frankly, we're only 2 days off of an all-time low. Last week, we had this just Meta Platforms and Alphabet, a couple other ones have advertising dollars, that type of stuff. The internet, network and stuff with the social media. It's just gotten crushed. We had a nice bounce in this thing today. Meta Platforms was up like $5 or $6, and it's erasing that already. RSI, 14-day RSI is below 40. MACD is 40. These are not something that you want to touch yet. It's got a bearish chart. We're making lower highs, lower lows. In fact, we just made a new low in this thing 2 days ago. So you want to avoid those stocks at this stage. Even if we have a rally, you're not going to get the end of the year bounce in this sector. Also, another one we can look at real quick that you probably want to avoid. That's the consumer discretionary. That's XLY. And if you look at that, we're 1 day off of. About 2 weeks ago, we made a new low, and we're only about $1 off of that. Again, we have the 14-day RSI is below 40. It's down to 35. It's negative today. It's a big drag on the markets. It's kind of falling out of bed here. MACD is bearish. All the moving averages are pointed down. You're probably these stocks, especially XLY, is something that if they start getting more, one more bad CPI or PPI type report where they have to raise rates a half to 3/4, and you're probably going to have all this recession talk getting ramped up even more. You don't want to buy consumer discretionary stocks in when we're going to a recession. Another big drag on this has been Tesla after Musk bought Twitter. His stock has just been getting killed on that. It traded below 200 yesterday for the first time, I think since it's maybe 2 years or 2 or 3 years. So that's when you want to kind of avoid. Now, if you are going into a recession, you would expect to see some of the defensive sectors outperform. And if you pull up XLP, we have the consumer staples sector. And with today's move, initially you bounced up above this 200-day moving average up here around 73. It got up to that area, that 200-day moving average last week. It bounced off of that 1, 2, 3, 4 days in a row, and now today we couldn't get through it again. That's a little bit of a problem. You want to keep your eye on that because consumer staples is an area, even when you go into start to go into a recession, people are still going to need toilet paper. They're going to need food. They're going to need that kind of stuff. But I would caution that you don't want to just buy any of them. These are the kind of periods where you might want to look at some of the discount thing. Maybe your Walmart, your Dollar General, that type of thing. Maybe your Costco, things like that. But consumer staples should be a sector that if we firm up here in the fall, you probably could go in there. You don't need to go into it. The next sector would be XLE, which is the energy sector. It's all good. You got a little bit of weakness in here today, but you just want to stay in that. And I would be overweight energy. They say sometimes you want to be 10% in each sector. I would say energy, you want to be 15% or better. Okay, the next one we can look at real quick would be the financial. That's XLF. F is Frank. And the financials, if you're going to a recession, they're not your favorite sector. However, when you're having rising rates like this, and I think it was on Friday or yesterday, we actually the 3-month and 10-year yield curve is no longer inverted. That's actually good because that was the Fed's kind of go-to inversion curve that they always watch to as a signal recession is on the way. So that has become uninverted, if that's the right word. Today we saw the financials actually go up, tick above the 200-day moving average briefly. It also got up to it last week, 1 day, Tuesday or something like that, and couldn't hold it and came back. We're coming back today. But the 14-day RSI is up here around 61. If we can get through, let's say, 34.50 on the XLF, that would be a big sign. This is probably one that with rates where they are, especially if we end up going into a shallow recession or avoid one altogether, you're going to want to have exposure to the financials. And again, it's getting close to where you can see this thing, take a stab and get above the August highs. That would be a real plus for that also. Okay, the next one we'll look at real quick, another defensive one that I think is the place where you can probably nibble away, and that's XLV, the healthcare sector. Today early, and also let's see, last Wednesday or so, we saw the XLV healthcare sector actually get up here and hit the same level as we did at the August highs. It's trading above all of its key moving average resistance areas. It's pulling back here with the rest of the market as we speak. But healthcare is one that's even in a recession, you're going to need to buy these. Have exposure to maybe some of the hospitals, or some of the drug companies, pharmaceuticals, that type of stuff. Also, another thing that I wanted to mention, if with the split Congress, the drug companies will do much better. If you have a little bit of problem where the Democrats wanted to give away all the health care and everything, and watch the drug prices a little bit more. The big pharmaceuticals and stuff should do better under a Republican or a split Congress here. So that's one I think you can buy. Also, the 14-day RSI on this is around 61, 62. I think, again, if we get that in that 65, 70 area, that's telling you that we're going much higher than that. And 134 on the XLV would push you above the August high. Okay, the last one I want to look at real quick, Will, is XLI. That's the industrial sector. We've already gone over the 60. We retraced 61.8% of the sell-off from August down to October lows. So it's got a nice looking chart. It on the 14-day RSI is above 65 right now. We actually were, it's got to get up to about 100. We're 95, 85 right as we speak. So you get this above by another 4 or 5%, you're going to be making a run at the old highs. Industrials look strong in here. MACD is strong. You're actually a little bit overbought on the stochastics, but in this case, the industrial thing, I think part of this is both sectors or both parties in Congress are going to probably come to a conclusion. They had that, let's build back America or whatever you're doing. But I think you're going to start seeing more both sides of the aisle coming together to start doing some more of the infrastructure stuff, especially with some of these weather patterns that we're having and a lot of the climate crisis type things. You're going to have to start. They're going to have to start building out some of these things. And again, according to the 14-day RSI theory with Tony Brown, this thing is in a nice uptrend, and it should continue and be one of the leaders going forward. The other two sectors, real briefly, are XLU and XLRE, the REITs and the utilities. When rates are going up, they're less attractive. If you're going to be defensive, you can, like I say, you probably want to go with the consumer staples, that type of thing, and the energy, and some of those that we talked about earlier. So if I went too fast for you, these are some of the sectors that you could probably nibble away. And if we're going to firm, the market's going to firm here, the last part of the year here. Those are the sectors that I mentioned that look strong or where you want to go. Until we start seeing a pause, you can probably, stay away from the technology stocks. Maybe you nibble away on some of it to get a real big hammered low. Some of the semiconductors you might want to pick up because they'll lead the technology sector out of the dumps here. But I think maybe sometimes when you see some of those tech trades get overbought, you probably want to take your profit in those things and let them come back down because I don't think they're going to go do much here over the next month or two. So that's about it on this end, Will.
All right. Well, that's all we have for you today. All right. Well, that's all we have for you this week. Remember, if you have a question you'd like to answer on the next Tuesday Tech Talk, email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.